personal interest code area highlighted. Welcome back to the channel. Today, we are executing a technical deep dive into Section 70203 of Public Law 119-21, the One Big Beautiful Bill Act. If you have practiced tax any time in the last 40 years, you know that the Tax Reform Act of 1986 effectively killed the deduction for personal interest. For decades, the Internal Revenue Code has operated on a simple premise: mortgage interest is deductible, consumer debt is not. Section 70203 fundamentally alters this landscape for a 4-year window, specifically tax years 2025 through 2028. It amends IRC Section 163H to exclude qualified passenger vehicle loan interest from the definition of non-deductible personal interest. Crucially, this is an above-the-line deduction, meaning it reduces adjusted gross income, AGI, directly. This placement is significant. By lowering AGI, this deduction can trigger downstream benefits for other AGI-sensitive calculations, such as the new senior deduction or medical expense thresholds. However, the statutory eligibility requirements are rigorous, and the phase-out math is punishing. In this briefing, we will break down the 4-gate eligibility test, the CLIF phase-out formula, and the specific traps regarding refinancing. Before we calculate a single dollar of deduction, the loan and the asset must pass 4 specific statutory gates. Failure at any one of these points results in a disallowed deduction. Gate 1 is the date of indebtedness. The statute creates a hard, fresh start. The deduction applies only to interest paid on indebtedness incurred after December 31, 2024. This is a bright line test. Interest paid in 2025 on a loan originated in 2024 is non-deductible. There is no grandfathering of existing debt. Gate 2 is the final assembly requirement. This is where Section 70203 diverges from previous clean vehicle credits. The vehicle must undergo its final assembly within the United States. Note the specificity. This does not include North America broadly. Assembly in Canada or Mexico does not qualify. As a practitioner, you must verify this via the Vehicle Identification Number, VIN. Generally, a VIN starting with 1, 4, or 5 indicates U.S. assembly, but you must validate the specific plant code because manufacturers shift assembly lines annually. Gate 3 covers asset specifications. The deduction is restricted to new vehicles where the original use commences with the taxpayer. Used vehicles, regardless of mileage, are ineligible. This effectively disqualifies lease buyouts, as the vehicle was previously used by the leasing entity. Regarding weight, the vehicle must have a gross vehicle weight rating, GVWR, of less than 14,000 pounds. This threshold is generous enough to capture heavy-duty consumer trucks, such as F-350s, but excludes commercial semi-tractors. Gate 4 is the use case. The statute specifically targets personal use. If a client uses a vehicle 100% for business, the interest is already deductible under Section 162. Section 70203 applies to the personal portion of mixed-use assets. For a vehicle used 60% for business and 40% for personal reasons, you would deduct 60% on Schedule C and test the remaining 40% against the Section 70203 caps. Now let's look at the math. The deduction is capped at $10,000 per taxable year, but the real complexity lies in the modified adjusted gross income (MAGI) phase-out. The phase-out begins at $100,000 MAGI for single filers and $200,000 for married filing jointly. The reduction formula is aggressive. The deduction is reduced by $200 for every $1,000, or fraction thereof, by which MAGI exceeds the threshold. That phrase, or fraction thereof, is critical. It forces a roundup function in your Excel models. If a client is $1 over the threshold, they lose $200 of the deduction immediately. Let's run a scenario. Julian is single with a MAGI of $120,100. He bought a US assembled truck and paid $4,800 in interest. First, we calculate his excess income. $120,100 minus the $100,000 threshold equals $20,100. Next, we divide by $1,000. That gives us 24.1. Because of the fraction thereof rule, we round up to 25 reduction units. 25 units multiplied by $200 equals a $5,000 reduction. Since his actual interest paid was only $4,800, the $5,000 reduction wipes it out completely. Julian gets zero deduction. This highlights the effective phase-out concept. While the statutory range suggests the deduction creates a benefit up to $150,000 for singles, that is only true if you have the full $10,000 in interest. For most borrowers with interest between $3,000 and $5,000, the benefit vanishes much earlier, often within just $15,000 to $25,000 of the threshold. A major trap for the 2025 tax year is refinancing. The statute and subsequent guidance clarify that you cannot refinance pre-2025 debt to qualify for this deduction. That debt is permanently tainted. However, refinancing eligible post-2024 debt is generally permissible, provided the principal balance does not increase. Cash-out refinances will likely bifurcate the loan, rendering the cash-out portion non-deductible interest. Advisors must track the principal strictly. Regarding compliance, the IRS issued Notice 2025.57 providing transition relief for lenders. For tax year 2025, lenders are not required to file a formal information return with the IRS. Instead, they must provide a statement to the borrower by January 31, 2026, showing the interest paid. This places the burden of substantiation on the taxpayer. You must ensure your client retains the Monroney label, window sticker, to prove U.S. assembly, and the original sales contract to prove original use. The IRS will require the VIN on the tax return, and we anticipate automated matching against NHTSA databases to validate assembly origin. Section 70203 is a potent, albeit temporary tool in the OBBB arsenal. For clients in the sweet spot, moderate income with high vehicle financing costs, it provides significant relief. But for the practitioner, it requires a higher level of due diligence. You cannot simply take a client's word that they bought a Ford. You need the date, the VIN, and a precise MAGI calculation to ensure the deduction holds up under scrutiny. Run the numbers early, watch the phase-out cliffs, and make sure those window stickers are scanned and saved. Thanks for watching this technical breakdown.